Good morning, everybody. Good morning. Good morning and welcome to the Big M&A Debate. I'm excited. In my 10 years at VouchedFor, I've never fielded so many questions from our members, both buyers and sellers, related to M&A. There's obviously a lot of change going on. There's a lot of strong opinions. There's a lot of differing opinions. And we're going to get to the heart of all of that today. Agenda-wise, I'll kick off with some quick intros. So from each of our panelists, Vicky here is then going to do a quick scene setter on some of the main things to be thinking about around this space. We're then going to get into the main segment of this morning, where we'll be fielding your toughest questions in a question time style format. Those of you that have watched Question Time will know that people don't always agree. That's good. I'll be doing my best Fiona Bruce impression in stirring up healthy debate, trying to make sure we cover all of the key themes that I know are front of mind for you. Despite being follically challenged and the kind suggestion of one of my team, I won't be donning a Fiona Bruce wig. You'll be glad to know. But the plan is ultimately that you all get value. At the very end, I'll be doing a 5-minuter on some of the ways that people are using client feedback to help make sure that great client outcomes remain front and center throughout the M&A process. Our collective goal is to ensure that you all leave here with some valuable food for thought, but also we want to make sure you have fun. Let's have fun. A lot of the events in this space can be a bit boring, so let's have some fun. With all that said, let's get into some intros. So I'm Alex. I'm MD of VouchedFor. We're really passionate about the value of good advice, and we want to help everyone access it. The driving force behind everything that we do is client feedback, and there's two main parts to our proposition. Elevation, which is an enhanced client survey that helps firms monitor and improve client outcomes, including before, during, and after the M&A process. There's also VouchedFor, the public review site, which helps firms build trust and organic growth. Across the two propositions, we collect feedback for just over 10,000 advisors across the UK, so a fair chunk of the market. We've also got first-hand experience of M&A. We sold a financial coaching business to Octopus a few years ago, and about a year and a half ago, VouchedFor itself was acquired by Fintel plc. Vicky.
Good morning, London. You meant to say good morning, Leeds. Let's try again. Good morning, London.
Good morning, Leeds.
Hey, have we got anyone from Leeds in the house? You're my favourite person in the audience. So, morning, everybody. My name is Vicky Hicks, and I have the best job in the world. I am the CEO of Melo. We work with financial planning businesses, whether they are looking to grow or whether they're looking to exit. We always work for the firms that we are representing. We roll our sleeves up and get stuck in, essentially helping good firms to be great. So thank you, everybody, for coming along today, and let's make this event a fabulous one.
Thanks, Vicky. Phil.
Thanks. Hi, everyone. Already more anticipation and noise than obviously Emirates last night, so good to have you all here. I'm an exec director at HFMC Wealth, so we're an acquisitive, chartered, high net worth IFA business. So we focus on clients typically with 1 mil plus of assets, and we buy at least one IFA company a year and then integrate it.
Thanks, Phil. I'm Dan Boardman-Weston. I'm the Chief Executive of BRI Wealth Management. We're based in the Midlands with sort of operations across Warwickshire, Worcestershire, Staffordshire and Derbyshire. Team of 40, very much a financial planning firm, but our genesis of firm was very much from a DFM background. But we've sort of seen the light over the last 10 years, as my colleagues like to refer to it, and pivoted towards full financial planning, typically for business owners and high net worth individuals.
Thanks, Dan. Hi, I'm Gabby Beaumont, the CEO of 149 Group. We're a national independent chartered business. We've got about 2 billion of assets, having acquired 10 businesses. Again, a kind of focus on higher net worth clients and a real focus on integrating and digesting the businesses that we take on board. Looking to acquire kind of 3 a year if we get on really well with them. So that's all about, it sounds crass, but cultural fit and getting to know the vendors within the businesses that we're acquiring, the people within them. over to Tom.
So I'm Dominic Rose, Chief Exec of MKC Wealth. We're a sort of boutique wealth management business, also going through acquisition, partly the reason I'm sort of sitting up here. But over the last sort of 18 years or so, I've done quite a lot of transactions in the space. I've done around 200 acquisitions for multiple firms over the course of around 18 years. And made quite a few mistakes and cocked up a few. So I'm hoping that I'm going to be able to give you guys the benefit of some of the insights as to just on what I have seen works well, what doesn't work well, what the things to look out for when you're considering this and going through the process. But MKC, we're a fairly sort of boutique wealth management business, 40 financial planners, sort of 5 offices, a total team of 150.
Thank you all. And we've got Ben in the audience who's going to be fielding your questions. Ben, do you want to do a quick intro?
Hi everyone, I'm Ben Wright, Chief Innovation Officer at Melo, and I run our progress function. So anything about making firms better is my bag, and today I'm going to be running around with this microphone making sure your questions are posed to our panel.
Excellent stuff. Thank you all. Looking forward to hearing what you have to say shortly. Just before that though, Vicky's going to quickly set the scene for us, and then I'm delighted to say that the Spanish Inquisition style light will be switched off and we'll jump into the question style bit. Vicky.
Everybody exits. One day, you will all exit your business. You'll either walk out, you'll be pushed out, or, is that working? You'll be wheeled out. And option number 1 is the only route that you have control over. Okay, so my aim is to encourage business owners to look at exit not just as a transaction, but to look at exit as an entire phase in your business life cycle. It is not easy to sell a business in a post-consumer duty world. It is a completely different beast. I wish I had realised how easy it was to sell a business 2 years ago. I would have probably enjoyed it a bit more. But as we sit here today, it is more and more challenging to exit a financial planning firm. So you need to give yourself plenty of time to make sure that you can get all of your ducks in a row, to make sure that you can present your business absolutely in the best possible light. So we're here today as a panel of experts to talk to you about some of the routes to looking to sell your financial planning firm, and we're focusing particularly on the external sales route. So of course, what we all know is that there are internal options to sell as well. So we call those selling to your team essentially, whether that's a management buyout or whether that's via an employee ownership trust. And that is a completely separate conversation, although I imagine there'll be a couple of questions about that today, which we're more than happy to answer. But what we're really focusing in on with today's meeting is the different types of acquirers that exist, from your local acquirer that might seem more culturally aligned to you, all the way up to your private equity-backed consolidator. If you own a limited company, you will probably want to sell your shares, okay? It's a much more tax-efficient route to exit. And quite often business owners will say to me, I own a limited company and therefore I want to sell my shares. It is not necessarily a choice that you have. What acquirers have always looked at are 2 things, okay? Very simply, we can distill it right down. Buyers are looking at opportunity and risk. It used to be like a set of scales, okay? So if opportunity trumped risk, then buyers would tend to move forwards with that opportunity. And what we have to think about as well, if we go back a few years, is the amount of competition that was in this space. So around 70% of private equity money came in a 2-year period. So you can imagine we had all of these acquirers that were competing over businesses, prices rallied, and if you were to ask a few of them today, would they have made those purchases now? They'd have probably said no, okay? So we're in a different space now, and we have to ensure that we're planning properly to try to secure that share sale if indeed you are running a limited company. Who is on your deal team? So some of what we're going to talk about today is the importance of recognising your own limitations when it comes to sale. You are probably already very busy as business owners running your firm, and you're about to go through something that perhaps you've never experienced before. So surrounding yourself with the right team of advisors who can prepare your business, who can present your business, who can protect money that you're due to receive is absolutely vital. So thank you, and back over to you, Alex.
Great stuff. Thanks, Vicky. So into our questions. Whilst it's a dominant theme, not everybody in this room is sold on the idea that consolidation is a force for good. We're going to kick off with a question from Greg Crawford. Where's Greg?
Okay, here we are, Greg. Over to you.
Thank you very much. Mine's basically, Vicky, it follows on what you'd said, is why would a business sell to a consolidator when it could go the MBO route?
Thanks, Greg. Gabby, do you want to take that one?
Sorry, could go MBO, did you say? I think it totally depends on your objectives and also whether an MBO route is even viable. So we meet quite a few vendors who have explored the MBO route and realise it's not viable. So if that is viable and something you want to explore, then that's great. But I think valuations have meant in a number of instances that's not viable. So you're looking at a consolidator route, and then it's for you and your advisors to work out the best home to go to. And I think consolidators are very different. There's a whole spectrum of consolidators, and it's for you to work with your advisors to work out the one that's best for you. So we're not hugely acquisitive. Like I said, we're acquiring about 4 businesses a year. But you've got to have the infrastructure to integrate these businesses, I believe. You can't just, with wild abandon, go out and buy loads of businesses and do nothing with them. You have to have the infrastructure and capability to bring them on board. So I think, and I always say this to vendors, you have to understand what life looks like on the other side of the transaction, and for you to get comfortable that that suits yourself as the vendor, your people and their development, and most importantly, your clients. Is it the right home for them? Because all consolidators are not the same. They're very, very different. So I don't think it's a question of, is it an MBO or a consolidator? It's a question of who are you selling to, what do they stand for, and what does life look like after?
Thanks, Gabby. Phil, do you want to answer?
Yeah, I'd just add to that slightly. I think one of the questions that firms often ask is what's going to be different after the event to what's going to be if I sold as an MBO. And one of the reasons why quite a few, certainly smaller firms, come looking elsewhere is thinking about their proposition, thinking about intergenerational planning, thinking about the digital proposition that's almost certain to be needed as we go forward over the next, certainly 3 to 7 years. And are you going to have the capital available to invest in that business under an MBO structure so that you get your earn out and your clients get the outcomes that you spent your whole life trying to deliver to them? And if you don't think that that MBO team is going to have the capital to support the needs of your clients going forward, then it's actually quite a short-term transition. So you do need to think about what that proposition is going to look like. What's the structure of your client bank looking like, and what are their needs? And ultimately, why haven't you already delivered that proposition or already? So just think about it from that perspective as what those next steps post you are going to be and what that delivery needs to look like.
Sorry, if I could just also add to that, because I absolutely agree with Phil and Gabby in terms of the capital availability, but it also then leads it to about the team alignment, right? So if you're doing an MBO, then you think the team are really aligned behind continuing to build that business. So key consideration, this may seem obvious, but key consideration with any firm that you do decide to partner with, should there not be capital for an MBO, is around how are that team going to feel? What's the reality like for that team? How are they aligned to the firm that they're going to be joining? We give everybody equity in the business. So everybody comes and joins us, they get equity. So it's in some ways achieving a similar outcome to the MBO, albeit they obviously don't then have the control over the advisory proposition.
We're going to talk a bit later about risk. Obviously, the FCA is focusing a lot more on this space. There is potentially a risk that staff are less well placed to understand the risk in the business that they'd be buying into as part of an MBO. Vicky, do you have anything to offer on that front?
Yeah, I mean, a successful MBO is entirely dependent on people. And what's really interesting, we did a presentation probably, a year or so back with M&G, and I did a poll question out to all of the audience. I think there's about 300 odd business owners that were listening in. And I said, if you had to sell your business today, would you sell your business to the team, or would you have to sell on the open market? And the majority of people said we'd have to sell on the open market. But then I asked the question, what if you had 5 years to go? What would be your preferred route? And the majority of people actually said we would love to have the team internally that we could transition the business to. So when MBOs work, they work really well, superbly well. But it's a very long term to actually get to the point of signing on the dotted line and doing the MBO. Essentially, as a business owner, you need to have made yourself fully redundant from that business. You need to know that you're no longer required at all. And that gives you the confidence then to say, right, it is the time to do the management buyout or look at an employee ownership trust. And what that means is, along that journey, you've got to start as a business owner to relinquish control. You've potentially got to look at relinquishing some shares and things like that. And that can be really hard, right? Attracting the right talent, retaining the right talent, being willing to let go, right? It can all work. MBOs, as I said, are great, okay? I'd love to have at some point an MBO EOT debate, by the way, because I'm team MBO as opposed to EOT. If anybody has any thoughts on that later on, we can definitely have a conversation about that one. But if you really want to go that route, there's a lot of work that you've got to do, I would say, for a good 5 to 7 years in advance.
Greg, am I right in saying you've been through an MBO? And if so, any regrets, anything that you can share with others in the room who might be weighing up the pros and cons of that versus an external sale?
Yeah, you're right. We have been through it. We're still going through it in a way that I suppose the regrets are getting the legals right, choosing somebody that, pardon the expression, doesn't fuck it up. Because it can go wrong, and unwinding it and getting it all correct with HMRC can be a bit of a problem. So yeah, I think having the right team, the right advice around it, what can look very good on paper might work in theory, but doesn't always work in practice if it's not implemented correctly. In terms of the people in place, I think we've been lucky with who we've had in the business, working through the business for a number of years. The next step, like many of you have mentioned, is the next people who are coming up, and I would struggle to identify those next ones if indeed in 10 years I disappear. I don't know who's next.
Yeah, but you've got time to work on it. Yes. Yeah, brilliant. And you're thinking like that, which is great, right? You've just stepped into this new world, and now you're thinking with the end in mind. So, well done.
If people do ultimately sell externally, a big consideration is, of course, what happens to clients. We've got a question related to this from Laura Handy. Where's Laura?
Where's Laura? I'm going to come down this row. Do excuse me. That's all right.
Ben's getting his steps up.
Thank you. Hi, can you hear me? Yeah, great. Hi. If clients are disadvantaged post-sale through things such as higher fees or a worse service being offered from the consolidator, who's responsible for that?
Dan, do you want to take that?
Yeah, I mean, in my mind, I think it's the person acquiring the business, to be honest. If they've dropped the ball and have upped the fees and the service hasn't followed through, or they've not delivered on what has been promised to the client, then it is up to them to make it right. What I would say is that it's in everyone's interests to get the deal right, because it clearly affects consideration for the purchase if there's a decent amount of client churn. So everyone should be aligned in theory on making sure that clients are looked after in the most appropriate manner and they continue to receive good quality service, and then everyone's happy, the clients, the vendor and the acquirer.
And just Vicky started talking up about risk. The biggest risk for any buyer is clients leaving. So that is front and foremost of almost everything that we do, is to avoid any client attrition. In fact, we want the opposite. Everything we're seeking to do is enhance the client experience, because that makes for a better business. If the client's being disadvantaged, they'll go. So anything that points towards them being disadvantaged, you want to move away from. And that comes back to the point. As a seller, you want to know exactly what's going to happen to you, the vendor, to your people and your clients. And as much granularity you can get on that at the outset, the better.
I'm just going to say, I agree that it's the acquirer's risk, but I think there's something definitely in your due diligence of the firm that's going to acquire you that's really important. You need to understand what that proposition is going to look like. So when we do acquisitions, in some of our SPAs, our share purchase agreements, we have some terms around what we are going to do or will not do with clients, right? So a firm has the ability to grandfather fees if they're trying to treat them all the same. We don't have to take your fee structure and immediately turn everybody into the same fee structure that we have. So we can treat different groups similarly, so long as it's going to meet those grandfathering rules. But be under no illusions that the firm that is going to acquire you is acquiring you for a reason, right? There's a strategic reason they're going out and growing what they're trying to do, whether that's growing their own business to improve their own multiples on EBIT, whatever it may be. There's a reason they're doing that. And not every one of your clients that they're going to acquire potentially is going to fit the target market of that group. Hopefully, there's huge synergy, right? Otherwise, they wouldn't be doing the deal. But some of those clients might not be. Yes, okay, little Johnny might not be a high net worth client for us, but we see that as intergenerational. But if we come across a household, and I'm just going to give you a number of, say, £250,000, with the way that we look to service our clients with higher touch, that's not going to be a profitable household for us. So what we're going to be looking at is having conversations with that advisor as to whether our proposition is going to provide the best value for that client. So it may well be that that client is better off served by a different proposition that we do not provide. Now, I know that already when I'm looking to acquire a firm, right? I'll have done my due diligence. I'll have looked at your makeup of your clients. I'll have identified what the AUM by household is. And this is all in the due diligence, if you didn't know, it's coming your way. And so I'm going, right, I'll offer X, but I'm going to discount in my own mind that actually that part of the book likely isn't right fit for us. And I'm going to be thinking about what the solutions might be. And we'll be upfront actually with our the teams we're looking to work with, because transparency is everything if you're going to have a positive relationship going forward. Everyone needs to know, because we're looking for the advisors to effectively continue to run their book and transition it beyond the sale, certainly for a period of time.
Perfect question. Time to ask a question that came in anonymously before the event, which is, does consolidation help or hinder the advice gap fill? What's your take on that? And related, what happens to those lower value clients that you've just described?
So I would say it helps. Now, the reason I'm saying it helps is because what you've got to think about is, what is the target market of the firm? And if I'm not your target market, that's okay, right? You need to understand what that target market is. I need to understand it. And if a client isn't that, I actually believe they'd be better off served by working with a firm that's targeting them. They're going to get far more attention than they would from my firm. Their outcome is going to be better if they're not working for me, if they're not my target market. So I think, particularly under consumer duty, we all have a responsibility to look at what it is we provide and whether it truly fits that client type or segment. And if it doesn't, it's okay. Maybe you sell it to somebody else as part of a book rather than part of the whole, or you exit it and you find one of your colleagues who is better suited to that type of business. So it doesn't have to be black and white bad.
We were having this chat outside, weren't we, Dom?
But we were. It wasn't the point I was going to jump onto, but I can come on to that in a second if you want.
Yeah.
But just to pick up on one of the points that Phil's just made, which is just honesty and transparency. What you will find, I can almost guarantee it, if you go and meet multiple people who are looking to buy your business, you're going to have people just selling you the dream. All right, they're going to tell you, yeah, everything works beautifully. We'll service every single client. Your fees won't go up. The service is amazing. And if people are saying that to you, it's probably bullshit. Sorry, excuse my language, but it's just about the honesty and transparency about where you specialize, where you're good at. Phil's been really articulate about where his business specializes. We do the same thing when we're meeting with people. So just a red flag, I think, for each of you is when you're sitting in a meeting and somebody's telling you that everything works absolutely perfect and they can do absolutely everything that you're doing, just do a bit of diligence on it.
I think as well, like it also makes me question the strength of the acquirer's business plan. You know, because if you're looking to acquire firms, you should be super confident, like this is us, this is how we operate, this is what we provide. And you've got to have that buy-in from the seller. You know, I always say to sellers, would you put your own money with the company that you're selling to? Like that's a litmus test. And if the answer is no, don't sell to that firm, because there's absolutely no point in trying to push against the tide. You know, when you've sold your business, you've sold your business, okay? And the true success of any sale is integration. You actually have no idea how much your business has sold for until the last check hits your bank account. It's not about the headline offer. And once you've signed on that dotted line, and that's your responsibility as shareholders, as owners, to get the deal that you're comfortable with. But once you've signed, it then becomes about your stakeholders. Because the way that most deals are structured is you're going to leave a decent wad of cash on the table, you know, probably 50 or so % of the consideration for your business is going to be paid to you over future years, dependent on something that might be retaining the clients, retaining the profit, retaining the recurring revenue. And that's only going to happen if your stakeholders can thrive in that environment post-sale. So cards on the table, total honesty about what you do as a seller, about what they provide as a buyer. Does 2 + 2 equal more than 4? And if it does, great, you know, let's talk further.
And this is where doing your diligence comes in. And we talk about, and you hear about all the diligence buyers do on your firms. You've got to do as much, if not more, diligence on the firms you're going to for exactly that point, because your earn-out is in the hands of the buyers at that point. So you need to know precisely what's happening. I keep saying this to you as vendors, to your clients and to your staff post-transaction. So we just labour it. We go in on the first meeting and we say, there's going to be change, and anyone that tells you there's no change, they're either lying or they don't know what they're doing, which is ordinarily the case. So we really labour, there's going to be change, and this is what that change looks like. And it's only if you can get comfortable and on board and know that you can thrive within that new environment that you're going to have a good deal. So we set it out, and we've got an acquisition pitch deck. I'm looking at Sanjay, our corporate development director, and we send that out in advance, and you can read that. You know exactly what's going to happen. It's got all the integration steps. We put it in the heads of terms. We put it in the SPA, and we start that integration process prior to completion. So that is where it's at these days.
Or you go for something that doesn't necessarily have a lot of change.
Yeah, because it's similar to what you've
again,
got already.
in your buyers, you're going to have different propositions. Some will come in and they'll change your name right away. They'll look to get new client agreements right away. There'll be potentially people trying to move you into different investment propositions right away. Or there are firms out there who are looking at you saying, do you know what, you're a great business with a great advisor and a great client set out there. That's what we want to buy. And it's not so much about those synergies and moving into something else. So it may well be that your existing client agreements can be respected and kept. The fees can be kept. The name maybe can be kept. And what you're really trying to do is get a transition from your business into someone else's business with as minimum disruption as possible to the client, because it is certainly our belief that disruption events are the reason clients leave. So if you can minimize all those disruption and you can minimize the change, then you are going to have a far safer transition of your wealth into your hands through that earn-out period, and you can stay in control of it if, for example, you're still working for that firm and transitioning your succession advisor in with them. So that's all part of the deal, the art of the deal, some might say.
I do think you need to be wary, though, of the words, don't worry, nothing will change, right? to Gabby's point, that is just not true. It will change. Right? It's just how it changes, when it changes, and just making sure you have the absolute clarity on what the impact is for your team and your clients during the course of that process. I would also strongly recommend get references from the people who've gone through the process before you. Most buyers will have done it multiple times in the past. They will have people who've gone through the process. Just talk to them, get the benefit of their experience, what's gone well.
I couldn't agree more with that. We're relaunching our website and it's riddled with references from vendors. So that is the best source of reference. Someone that's been through, who's kind of 3 years into the earn-out, out through the earn-out, been through everything. What better way to understand what's going to happen than speaking to someone that's been through it?
I'm going to move on to the next section.
Can I just come in briefly on this last question while you're sorting your mic out? I think we've touched a little bit on client, but we're not really talking about clients. We're talking about vendor and acquirer. For us, getting the client side right is crucial. Yes, you need to ensure culturally firms are aligned and they've got the right target market and the right products and processes and all of that sort of stuff. But the key thing for us is matching the right client with the right advisor that has got the right technical capability and also that has got the right personality. That is the biggest thing that we find when doing deals can make or break a deal. At the end of the day, all of our businesses are based on goodwill. It is clients. It is we've got a relationship with the client and they trust us with their money. And that is the key thing to try and remember when going through that process and matching them with the right advisor is just so crucial.
Quite right. Absolutely. I was, going to make the point. I know that there's a lot of discussion around different funding models, particularly the pros and cons of private equity backed acquirers. Keen to head to our next question on that. Just before I do, though, show of hands on the panel, which of you are private equity backed? Gabby and Dom. Dan and Phil, debt backed? Okay, so
Good old cash on balance sheet.
okay, same for you, Phil.
We have that. We have debt fund to help us with acquisition, but we're entirely private and family owned.
Okay, helpful context. Let's go to our next question then, which is from Greg Neal. Where's Greg?
I believe that every business person should know who their master is, who they serve, if you like. And for community IFAs like me, I serve my clients. I answer to them. For regional and national firms that take external funding, particularly private equity, who do the directors of those firms serve?
Dom, do you want to take that?
Absolutely, we serve the clients. Right? Absolutely, we serve the clients. To put that into perspective, in MKC, everybody's remuneration is partially, and everyone's bonus is contingent on client feedback. Right? We are there to serve our clients. And if you're getting poor feedback, you're not having any bonuses, right? And if you're consistently getting poor feedback, then we're probably doing something really wrong. But the point is, we do still serve the clients. But there is clearly and I was in a private equity backed business in 2012, and they were an aggressive, actually got to probably be careful to say, they were quite a punchy USPE firm and there was a failure there to manage their expectations, right? And that led to pressure to go and acquire more. And there wasn't the operational infrastructure to support the clients being bought, right? And in that business, I had to make a recommendation. We should not be acquiring. I cannot look business owners in the whites of the eyes and promise them we'll be able to look after their clients. And the real disconnect with the PE people there was, well, no, we love it, go and double it. You guys are missing the bloody point. I then went into corporate, having had that experience, and then spent the whole time arguing against private equity. Okay, but I'm now back in a private equity-backed business, having found the corporate had grown too large. But actually, it's around managing the expectations, making it really clear that you've got the alignment of the PE firm and the plan. PE will always push you to increase returns. Of course they will. It's a management team's responsibility to set the expectations to what is reasonably deliverable and when, and to push back if there's unreasonable pressure for short-term returns. Because ultimately, we serve the clients.
Phil, you've chosen not to go down the private equity route. Why?
Yeah, well, I would say we've chosen not to go down the private equity route yet, is what I'll say. So I'm not going to rule out private equity full stop. I'd be a fool to do so, because ultimately everyone in this room is going to again exit at some point or be wheeled out, right? So for us, we went through a process, even with ourselves being looked at a number of years ago, to help one of our exiting shareholders. And to Dom's point, there's a range, right? Under everything gets called PE nowadays. It's just private money. If you guys wanted to invest in my business, technically that's private equity, right? So you've got everything from Canadian pension funds and longer term VCT holds who could invest in your businesses, through to the punchy American who's saying, I've got a fund that's got a life. It's a 5-year life. And you might be one of their acquisitions 3 years into their 5-year life cycle. So they're going to try and exit you in 2 years' time. So when we talk about PE, it's not as simple as PE good, PE bad. I don't believe that. I really don't. Because there's plenty of good PE out there who are longer term money, who understand that it's going to be a long term hold, play, and they're not after some aggressive CAGR when they're trying to exit you. That has to inform your decision as to who you invest with, because again, you're thinking, well, am I going to be flipped again in 2 years' time? Suddenly I've given up control of my business to somebody, and I'm going to be flipped again in 2 years, and I won't know or have any control over who that might be. And that's one of the fears. Why didn't we use PE? Well, when we went through the process, we didn't find the right type of PE at that point in time. It's not to say it's not out there. It just wasn't right for us.
But just as all consolidators are not made equal, neither are all PE. They're totally different to all of those points. And what you can have, even if you have a different PE backer, if you've got a consistent management team that are managing the PE effectively, that's what you're looking to. It's the management team that are running the business, setting the expectations. PE is just a source of finance. And I can't emphasize enough the point. And Greg, who are we serving? Everyone's serving the client. Otherwise, none of this works. And we recently subscribed to VouchedFor to get that feedback. And we were up at 4.9. I think it's down up at 4.8 now. But everything is based on that client feedback. And that killer question, would you recommend me to someone else? We need to start doing something with those answers now. But it's about the client.
I was just going to say, I mean, look, I think we'd all agree that it is about the client. But ultimately, we all have shareholders, whether that's private equity or, sole traders, whatever it is. We are in this to make a profit, and that shouldn't necessarily be a dirty word. We're providing a service which is very valuable to clients, and we need to make a profit. So ultimately, we all want to do what's right for clients, but, shareholders need compensation for their capital at risk.
I do also think that private equity has wised up a bit over the past few years. I mean, they've been burnt, right? So some of them have come in, they've backed some of the firms that have just gone and scaled really quickly, bought anything that moves, didn't really do any due diligence, didn't really integrate anything, and it all fell apart. Kills a breeze. And then they've been burnt by that. So they've learnt from some of this. So I think a lot more of the money that's coming into the sector is wiser PE. Yes, they all do have a return to hit, but you just got to make sure you're setting expectations on how you hit that return.
I've also noticed a difference between the PE backers who understand financial services and they operate in this space, and then the other PE backers who potentially have just seen, the sort of demographics of this space as an opportunity to get into. They might have really disparate investments, and so all of a sudden that kind of shiny financial services, oh look, there's a load of people who are looking to exit, we can put them all together and we can double our multiple. The reality of that is it's a lot more challenging. And I think when firms are backed by private equity that really understands the finance space, they're a little bit more lenient, shall we say, especially as, if you think, when I said sort of 70% of this money came into the space between 2019 and 2021, Consumer Duty was like, it was a whisper in the distance at that point, okay? And that's completely changed a lot of the business plans of these acquiring firms. And financial services, kind of those private equity firms that understand that, they get it. The ones that don't, they want out.
I'm just going to say the last point I would make on your question actually is everything's great, whatever owner you have when times are good. The question is what happens when the world turns to shit. When the markets crash and suddenly those CAGRs don't look so rosy, your cost base is exactly the same, but your revenue, if you're on a percentage model, suddenly came crashing down. And what are they going to do? So the type of PE, again, is really critical because it's going to impact your culture based on the ownership that you have, because the pressure that gets put on your leadership team will trickle down. When somebody's going, actually, you need to hit a certain profit margin through there, and they haven't got immediate control over what comes in as revenue, income, where's the place that the PE firm is likely to hit if they don't have a longer term view? If they have a longer term view, fine. If it's shorter term and they're trying to flip and they're focused on that bottom line to get their multiple to get out, then they're going to look at your expenses. What can we cut to make this more profitable? Can we do this with less people, which can stress your staff and impact your culture and your proposition going out? So
just
be aware.
on that, Phil, thank you. I'll come back to you in a second, Don. I'd like to go back to you, Greg, because I understand that you've been through an acquisition where the proverbial did hit the fan. It'd be great to understand a bit more about your experience and also whether there's anything that you'd reply with based on what you've just heard from our panel, borrowing from that experience.
Yeah, I mean, it wasn't an acquisition. I was in a network that went down overnight, and it was a very nasty experience, and I was quite, I was quite unwell, and it was quite distressing actually, for me and my family. I guess, my learnings from that. I mean, you have to be pragmatic. Businesses has to grow somehow, and I think there were some really interesting points there made about different quality of PE. In my particular case, it was one very greedy individual. I guess my takeaway really, or my challenge to the panel would be, really, I would like to see some provision for the staff, the advisors, to the point that was just made, in the business planning when the shit hits the fan. Because if you're not prepared to put that in the business plan, why am I going to be prepared to be your meal ticket and hand over all my assets?
I think this is being borne out, if nothing else, in change and control applications. So the FCA are doing some of this work for you, and they've started asking all the questions. There's the Consolidator of the review. Clearly, all of this is with the client in mind. What the questions they're now asking are very in depth, and they're looking to the longevity of the acquirer, and they're looking to see that you've got the financial resources to keep that business going and to pay your earnouts and to withstand economic shocks. So I think the FCA is taking on a lot of that responsibility, rightly or wrongly. So the right questions, I think, in my mind, are being asked by the regulator about the longevity of what's going on with consolidators. But again, back to doing your diligence. And I know one of the questions was, can you meet the money? Can you meet the private equity? Absolutely, if you want to. And you can get a feel of that dynamic and that relationship between the private equity and the management team, because ultimately it's the management team running the business, and the pressure that's put on them in the bad times, you've got to trust the management team to do the right thing with private equity's backing. So it's all in the nuances. It's not a broad brush scenario.
I think one thing we haven't touched on, but is key to this, is when we talked about cash on balance sheet a second ago, it depends how the money's coming into the business, right? Whether it's coming in as debt or as equity, and the extent to which some of these buyers are overly leveraged. And obviously what we saw when interest rates rise post-Truss's mini budget was then people struggling to meet their debt covenants, right? So perhaps they hadn't integrated, they're struggling to meet debt covenants, and it's all due to over leverage. I mean, our business, we're entirely equity funded to start with. So first 3 years entirely equity. So it was all cash on balance sheet, right? Just from a private equity fund. But then we put in some leverage in a small way at the end of last year. So I would certainly encourage you to look at the extent to which the leverage in the business, because the pressure will come is when they struggle to meet debt covenants. That's when businesses get really, because equity backers, you can weather the storm. You can accept, you can have lower margin for a period, right? That's fine. Debt providers, it's a lot harder.
That's a good question for you to ask. If you're selling your business, what is your multiple against covenants? What's your debt covenant? Are you 3x? I think probably some of the Dominic, I'm sure, will be under 3x. You guys, again, likewise, I'm sure. But yeah, there are firms out there who are almost at the 6.
And how are they paying for that? And it's not just on the individual deal, it's on the entire business. So it's very difficult to understand all of that. And back to the point about the FCA, if you're getting a change of control through, and that's going through successfully, I think that's indicative of you've put forward a balance sheet that works. You have to put forward really long kind of financial projections for the entire business now.
Gabby, you're right. There were quite a few questions from the audience around, should the seller meet the private equity backer? Curious to know, Gabby, for you and Dom, how many of the sellers that you've done deals with have met your private equity backers?
Tiny minority. I mean, the option's there if they want it. But I think to Gabby's point, it's about the people that are running the business and looking after the clients.
I think the fact you offer it up shows there's nothing to hide. But in many instances, they're not that interested, really.
Okay, keen to open it up to the wider audience. We've covered, the case for selling externally versus, for instance, a management buyout. We've talked about different funding models where I know there's a lot of strong feeling. Do any of you have any questions that you'd like to put to the panel or comments? Got one here, Ben.
Cheers. So
Cozy.
we acquire various firms. We're on the buy side. And we find it very interesting. Obviously, most IFAs were selling their client banks either want to go down the SPA route, majority. We find an APA a lot better as a firm. So how do you handle the selling's expectation that you don't want to go for the SPA and you'd rather do an APA? Because one of the biggest caveats, I think, if you're a selling advisor, is basically closing down your firm to move or whatever it might be. So just as acquirers, how do you handle that conversation?
Is everyone clear what difference APA and SPA? APA means someone's buying the assets, right? Well, not the shares. SPA means they're buying the shares.
I think from my perspective, this is one of the first things that needs to come out. Typically we're talking about it in the first meeting. You get a sense relatively quickly about whether you could potentially work with someone. And there's no point leading anyone down the garden path if you only want to do an APA and they only want to do an SPA. So typically within the first meeting or the second meeting, we'll say, look, we would prefer to do an APA for these reasons. And that's where we're at, and we can part companies if that doesn't suit you. But again, you've just got to try and be as transparent as possible, as early as possible.
There's sometimes there's more levers you can pull as well, potentially with an APA. So when you look at it quite like binary and you sort of say, well, if I sell my shares, the tax is going to fall on me personally, and therefore it's going to be, 14p in the pound, as it sits today. If I sell my assets, the money is going to come into the business. It's going to be subject to corporation tax, and then I've got to get the money out, right? Okay, so we're talking about this additional tax charge of up to 25%. But actually, if you go a little bit further than that, there are certainly levers that can be pulled to try to move that deal more into the seller's favour, because the buyer's not picking up the liability. The buyer's not having to go to the expense of ultimately winding up the company, because the reality is buyers don't want your shares. Sometimes they have to buy your shares because you're either of a certain size and it's easier from a complexity point of view, or because they're competing and they want your business, right? But ultimately, they tend to go through the process of closing down that entity. So, when you've got representation that's sort of taking you to market and helping you to negotiate, if they understand the levers that can be pulled, still to keep the deal very fair for both parties, the art is in an equitable deal. In this space, if a deal feels too good to be true at the point that you kind of get that initial offer, then usually buyers will get buyer's remorse before they've even bought the business, okay? And then that's where we start to see deals getting chipped at, which isn't ideal. But there's certainly levers to pull to try to improve the position under an asset purchase.
It costs a buyer quite a lot to acquire the share capital in a business. Typically, this is where we find out how efficient everybody is, but typically we just get 150 grand to acquire the share capital in a business, including DD, legal costs, because the hurdle goes up on legal DD, compliance DD, because you're accepting that liability when you're buying the share capital. So what that does do is then it typically creates a floor in terms of purchase price and size of the business, below which many buyers, ourselves included, would struggle to buy the share capital and have to be buying the assets. Just because the fixed cost per transaction just means it doesn't work.
Any other questions on whether to sell and who to sell to before we move on? Take one down here.
Before we go to this question, can I just ask, what is that floor?
I think everybody's got different floor, and it seems to move every sort of 6 months or so. But yeah, for us, anything sort of below 75 million of assets under advice, we'd really struggle. We have done it for the right deal, but we'd really struggle on the basis of the cost.
Thanks, Dan.
Similar.
And I'm
We've only done share purchases, but
Have you? Yeah, that's your route, and I like that actually.
well, that's really a function of size. So we're looking at smaller asset purchases now. So
yeah.
it's
You're
about
ready for them.
it's all a deal cost. So if that deal cost is materially large for the size of the deal, it doesn't make sense because it hits the buyer and the seller through the entire deal cost.
I would say, like across the board, speaking to obviously a number of acquirers, if I was just to sort of put an average on that floor, businesses usually that are worth, say, sub $1 million to $1.5 million, you're looking at the asset sale route, and beyond that, you're normally into the share sale route. So, you could have a limited company that is super tidy, super compliant. That doesn't necessarily mean that you're going to be able to sell your shares, because as you've heard now, there's a real big cost that's associated with that. And so the best thing to do is get that guidance really early. If you're a few years away from exit, understand, if I was to sell my business today, what would the likely outcome be? And then you've got that time to make those improvements to try to get the business to a position that you could sell your shares, or you've got time to come to terms with it.
I'd just add to that. I mean, our ceiling is probably around 75 million because we're not willing to take on debt or get external funding. And so for us, we do entertain share purchase agreements at lower levels than that. Now, it's got to make sense and it's more costly and complex. But again, this is about the different sort of flavours of acquirer in the market and those different floors and ceilings that they've got.
Perfect. Well, is there a question here?
So my name is Sam Slomer from Engage FS. We're a small financial planning firm. I have some observations and then a question to finish, if I may. So we have done an acquisition a couple of years ago, fully integrated now, and we had one recently that fell out of bed after heads of term signed, which was a bit frustrating, but better than completing. First one was a share purchase, small, and again, going through that experience, I probably wouldn't do it again at that size because it's a pain. The second one was going to be an asset purchase, but we couldn't agree on some of the terms. That's fine. The lady at the back who asked about whose responsibility, I completely agree with Phil. If you're selling your business and your clients, to me, it's your responsibility to work out who you're going to work with going forward, because they're your relationships and goodwill, and it's you to do your due diligence. So from my perspective, I would be engaging with a firm to help you do that due diligence, because it's probably you're not going to want to do it on your own. So we are looking at maybe growth capital or the sort of next phase of our business, and whether that's selling or like I said, growth capital from some of the other firms that are out there. The question's to you, Vicky. How do you charge, and how does it work?
So, okay, loads. So we always work for the sellers. That's really important. My background is, for anybody that doesn't know, is in financial planning. I was a minority shareholder of a group, and we sold at the end of 2018. And I have never seen the soul get ripped out of a business as quickly as it was ripped out of ours. And to put that into some context for you, there was 22 advisors, 60 members of staff. I think I could probably count on one hand how many people are left. And the reason I mention that, I'm going to get to your question, is because it was that moved me into M&A. I was under a share purchase agreement. So when you sell, it's hard when you sell and you've still got quite a lot of your career ahead of you. It's a lot easier when you're selling to retire, because there's two parts to it. When you're selling to stay on, you've got to get the deal right, and you've also got to make sure that it's an environment that you really want to work in longer term. And this environment was awful, right? So I was under a share purchase agreement. I was time barred. That's usual. You know, you'll probably give 3, 4, 5 years worth of restrictions that you'll sign up to. And I had to leave my career in financial planning, and I wanted to help other people not go through what I'd experienced. And when I was looking and trying to really work out, you know, how did we get this so wrong? I realized that the way that the brokers quite often operate is full of conflict and bias. You know, they work for buyers, essentially. They're being paid, so many of them, by the buyers. And I was like, so where is the support for sellers? Where's that true sell-side support? So at Melo, that's how we operate. You know, we work for the sellers. We take them on a full journey from conception of exit all the way through to completion. We project manage it. It's not just about the introductions. And depending on how much I like somebody, that's how much I'll charge them. No, it's very, very transparent. We charge 3% of the purchase price, ultimately, up to a certain value, and then beyond that, it starts to get a little bit toppy. So we start to reel it back. But you know, my success is my seller's success, and I'm never gonna, you know, flaunt on LinkedIn about the number of deals that have been completed. In fact, it makes me cringe when I hear people's life work being distilled down into some deal, you know, because I know the success is how everybody feels after the fact, you know, a year later, 2 years later, 3 years later. That's my success, you know, in the same way as you as sellers want to pass what we call the Tesco test and be able to look your clients in the eyes and know you've done a good job for them years after sale. I want to do the same with the sellers that I work with as well.
Let's move to the next section. A big shift in this area, particularly as far as sellers are concerned, is how they think about preparing for exit. So both in terms of the amount of work to do and the time span over which preparation takes place. We're going to go to Tom Stanbridge for our next question. Where's Tom?
Morning, everyone. So as acquirers, what does good look like in terms of prep for sale, being ready to go?
Dom, do you want to take that?
Yeah, and it's quite a dull answer, I'm afraid. Data, really. It's not going to be an exciting bit. But it really is about just having absolute clarity in the data. Clearly, you need to know about how the reviews have been delivered, what was the outcome of the reviews, going back sort of 6-7 years. Have you got all of the information on the clients, the policy information, the assets, the income stream? So that's a big focus. It's not exciting, but actually if a business is unable to provide that, it becomes much harder. I mean, a lot of the transactions we do are with retiring principals, and often in some of those businesses, the data can be a challenge. We've moved on a bit from the handwritten ledgers, but it is getting better. But in those kind of businesses where it's usually one or two, you know, so one financial planner, two financial planners, and an admin maybe, a data challenge is there. So we spend a lot of time building up the database for them before we then bring it into our system. So it's around the data quality, compliance history and record, but also crucially understanding, and this is actually possibly the most important bit, but not possibly, it is the most important bit, is understanding what is the service and the experience the clients get. So being able to clearly articulate, right, so I've got this client, I see them this many times a year, this is how I see them, this is the documentation I give them, and this is what it feels like to be a client. As a buyer's objective, and our objective is to either at least maintain that and lower the overall cost or increase that level of service. So that's a massive focus on RDD, and therefore clearly articulating that is a key part of the preparation process.
I think also as well, like I cannot overestimate, I don't know which one I meant to say, right? Due diligence is a lot, okay? Like however bad you think it's going to be, however much information you think you're going to have to provide, you will have to provide more, because your business is going to be viewed through the lens of the buyer. So quite often in a smaller organization, you know, you've kind of gone along untroubled. You know, usually very rarely do we have issues with advisors having client complaints. So they usually have happy clients, happy staff, and it becomes a real shock when all of a sudden their business is looked at through the eyes of an acquirer and through the lens of an acquirer. So in advance of going to market, view your business through that lens. understand what is going to come later on in the process, and give yourself the time to look at whether you've got any gaps and whether you want to then, fill those gaps. Because what's really important when you come to run the sales process is momentum. And what can happen quite often is business owners might get approached either directly from an acquirer, or maybe you'll have all had the emails, we have a buyer in your area looking for a business just like yours, those sorts of approaches. You move forward, you have a meeting with said buyer, they get excited, you get excited, then they send you over a data request, and everything just grinds to a halt. And of course, you go back to running your business. The buyer starts to wonder, why are things taking so long? Buyer confidence starts to dip. So whilst the business, whilst it's you and your time and your space, get all these things sorted out so that when you do then move forward and meet a potential buyer and they say, can you provide me with you're like, ta-da, right? You're going to stand out against probably 80% of other sellers just by taking control of the process yourself and giving yourself that time before you start.
I can't emphasize that enough, and it sounds so boring, and I knew Dom was going to say data, but it is data, and it's not just the quality of that data, it's the speed at which you can deliver that data. It really shows how slick and well operated your business is. And just taking this to the extreme, we acquired a business. The vendor was, I say younger, he's my age, but he wanted to be part of a bigger business and come on a journey with us. But his ability to turn around the data was second to none. And that meant that we were able to open the data room, and I'm looking at Sanjay again, and move to completion within 5 weeks because of the quality of his data and his responsiveness. And hey presto, on the other side of the transaction, he does run a really excellent business, and his new business is incredible. So it's such a good litmus test of how well that business is operating. So that's a hygiene factor. I mean, you also need to have a real understanding of what you want. What do you want as part of the sale process? Is it an exit? Is it a continuation? What do you want? What does good look like for you on the other side? So that's a question we always ask right at the outset. What does good look like for you? And then back to this point about change, this kind of openness, I suppose, to change, and not a complete closed-mindedness that your business is the greatest thing in the world ever. Just an openness to evolving and changing is hugely important.
I'd underline the point around data with having sold a couple of businesses. Even if you have no intention of selling anytime soon, just collect data and organize it as early as you possibly can. One of our deals was held up because there was a logo that had been designed by an external designer 5 years previously that we had not used for more than 6 months around the time that it was used. And the entire deal was being held up because we didn't have a signature from the guy who designed it saying he surrendered all the IP related to that logo. And it was literally the 11th hour. He was halfway up Mount Snowdon with his family on a hiking trip. And I called him, as you'd expect, he had quite a dodgy phone signal. And I couldn't tell him exactly why this was so incredibly important because there was a PLC concerned, all sorts of confidentiality around that. And I eventually managed to get him to, on his mobile, sign this IP agreement. But it was stuff like that we hadn't predicted that, was delaying the deal in the 11th hour.
I was just going to say, so about 7 years ago, if someone said to me data, I wouldn't have known what that actually meant. So for those of you who don't know, and apologies if you're teaching you to suck eggs, when we go through this, typically, depending on the size of your firm, there's going to be 3 different sorts of requests that come into you. One's going to be around commercial, which is your revenue, your contracts, how you're structured, what you charge, those sort of things. And that's actually, I'm going to say, relatively straightforward to provide because it's probably in whatever back office system you have to some degree. Then you're going to have your financial due diligence around your debts, what you've got, how things are structured, what loan agreements you've got, what photocopier lease you have, all of that stuff comes in because someone's going to work out, am I keeping it? How long have I got to pay for it? All of that sort of stuff. And then you're going to have your legal due diligence, which is going to cover your intellectual property, what you own, all of that sort of stuff. And I say it does depend on the size of your firm, but it's a proper job. So if you're trying to be a financial advisor at the same time, imagine doing another job at the same time during the due diligence period for about 3 weeks. You will be doing little else and it will be stressful.
What we've touched on there, is all around the sort of factual due diligence side of things. There's another massive point here, which is the emotional side of it, right? And making sure that you are emotionally ready. Because in the entrepreneurial business owners, when you are selling your business, you are losing control. Right? You can no longer wake up in the morning, make the decision in the morning and have it implemented by lunchtime. Right? That is a big psychological switch for a lot of people. So yeah, get all of the data sorted and make sure that's all tidy, but you've got to be emotionally ready to relinquish control in the business to somebody else. And that is one of the biggest causes, in my experience, of where things go wrong, is there's that mismatch of expectations.
Just from my perspective, I think bringing it back to the clients, I think trying to ensure that clients haven't gone through vast amounts of change just before you're trying to sell your business, whether that's sort of change of platform or proposition. Most clients don't understand this stuff, do they? Let's be frank. That financial literacy in the UK is very poor. That's why they come to us. And so the only churn we've ever had from acquisitions we've done is where there has been a perceived, the clients have perceived too much change. The advisors changed network, we've changed platform recently. And the only clients we've lost is where the advisors joined us. He's become an employee of us, but they've gone because they felt there was too much change. So that would be the only thing I would add over and above data.
Thank you. I think Vicky's largely answered it, but we're going to take a question from Daniel Jones.
Thank you. Some of the question has been answered already, so I'm actually going to change it slightly. So thank you, Vicky. And I promise I'm not a plant. I'm Daniel Jones, head of M&A at Succession Wealth. I've been in wealth management M&A for going on 10 years now. And for my sins, forgive me, I was a buy-side broker for the first 6 of them before going to PwC and then ended up here at Succession. I've seen all sides of the deal, from being a buy-side broker to being advisory and now being on the buy side myself. One thing I speak to Dom and Gabby quite often is there's a gripe around buy-side brokers, and I think there's something that sellers don't really truly understand. The free service you get isn't free. There's a lot of, as Vicky said, conflict of interest, not only that we pay to the broker, so they actually work for us, not for you. But there's also differences where there's certain brokers that have very, very strong ties with certain consolidators. I'll let you figure out who that is. And also just how much more value you get from a sell-side broker, or potentially can do from a sell-side broker. And that's not just you as a seller, that's us as a buyer. As we said, the data that comes through, if a sell-side broker's worked with you for 2-3 months, that comes to us and we can actually get a deal done relatively quickly. Whereas if we put it all on you, it takes you 16 weeks to put something in a data room because you've got to do your own job. So that's a long-winded way to ask, what are your views on buy-side brokers? You've given it already slightly. And will you join us in disengaging with buy-side brokers and pushing the industry into a sell-side mandate?
So we've made the case, I think, well, for sell-side brokers, but quickly, show of hands, how many of you work with buy-side brokers?
How many hate them?
And who wants to take that?
Slightly playing devil's advocate, by switching from buy side to sell side as an industry standard, all of us as buyers are going to save a significant amount of money, and all of these poor sellers in the room are going to be paying a lot of money.
That's
not true, actually.
Absolutely not true.
That's also, no, it's not true.
I said I was playing devil's advocate.
No, and I'll answer that question why it's not true, because what Vicky just said about the 3%, we pay probably double that, nearly. But also, I'd be willing to up my valuation on a business if I wasn't paying a broker fee. And also, what they charge you is a lot less than what they charge us.
It all comes out as the deal cost.
Yeah. And like I said, it's not a free service because we bake it into our financial model. And it doesn't come off pound for pound. So if it's a 500k fee, you're not losing 500k, but you will lose something in there. Or like we come back to the due diligence costs, we won't do the deal if you're not getting the right return on investment because certain costs are going up in there. And what actually surprised me so much when I came into Succession is from when I was a broker to coming into here is the fees have doubled nearly. And the buy-side brokers have way too much power. They don't help you. They give you a 1-page or 2-page pro forma and see you at the end. And that's not all of them. Some of them are better than others, as we said, same with PE. But I do just think that we now need to educate sellers, as we're doing here today, is that just that education for everybody and that help for everybody is going to help the industry push forward and have better deals. Because how many sellers have met 11 buyers? Well, that's not good for anybody and you get deal fatigue. But if you actually have a specific 3 or 4 buyers in the room in a proper process, I feel that's the way that we should go for everybody.
Anyone else want to make any counterpoints in favour of buy-side brokers?
I'm happy to jump in. Unless you want to go, Gavin?
You go first.
Well, look, I think it's a bit like the private equity conversation we had earlier. There's a range, right? You've got some buy-side the buy-side brokers who are these throw mud at a wall and see what sticks, and they're just looking for the maximum price and perhaps not necessarily that concerned with where the business ends up. That's clearly in nobody's best interest, right? But you've also got some other people who we work with on the buy side who actually they just fundamentally do care about making sure the businesses they are bringing to us end up in the right place. Yes, their commercial model, there's a conflict because their commercial model is obviously the fees paid by the buyer, so there is a conflict. Would I prefer Sellside? Yeah, I do prefer Sellside advisory. I think you get more of an intimate understanding of the business in terms of the Sellside advisor and the seller, and therefore you're generally meeting firms in that kind of a process where you understand there's going to more likely to be a better fit. So I prefer it, but I absolutely think it's about the quality of the buy-side broker. So no, we will not be saying no, we're not going to work with them.
Come on, Dom. Let's create a new standard.
Look, I think there's 2 points. Number one is it is a deal cost, whether it's the seller paying or the buyer paying. It comes out of the deal. So I think arguably in many sell-side mandates, there's more work done because I think you're having to educate the vendors to charge them a fee. Whereas with the buy side, they're not seeing the fee. So perhaps you're having to educate them and do less work. But with all of these things, do your diligence, speak to a load of representatives, speak to Vicky, speak to others, see who's going to do the best job of representing your business. Because when bigger businesses go to market, they go out and they speak to corporate finance brokers and they engage with the best ones that's going to get them the best outcome. So do that for your business. Don't go to the people that are just knocking hardest at your door. Do the ones that are going to get the best deal for you. And that's not just the money, that's the right fit.
We touched earlier on the increased FCA scrutiny around this space. We've talked also about the importance of creating the right data as a seller to make yourself attractive to a buyer. We've had quite a few questions in before around the theme of kind of how should sellers best package risk to make themselves more attractive to buyers in future. Dan, do you want to tackle that?
When you say best package risk, what are you trying to get at there?
The main theme of the questions was around, what kind of data points should sellers be doing collecting on an ongoing basis? What can they do? Let's say, for instance, they've offered DB pension advice in the past. What can they do to reassure you as a buyer that you're taking on an acceptable level of risk?
Yeah, I mean, DB has been the classic risk that people have been aware of and comes up extensively in due diligence. And buyers will always, typically go and do their own work on that and get an external consultant in to review some of the files. If sellers can or have gone through that process before in terms of reviewing their DB risk, that's helpful. Clearly, ongoing advice is a big one. So again, making sure you've got documented reviews going back 6 or 7 years. That is a big part of our due diligence now. And it, again, goes back to the quality of the data that a lot of people have raised. A lot of people don't have that, and that can be a big factor. I think probably one of the final ones is also on customer vulnerability. To be honest, I think we've got a big issue as an industry, not really recognising it and not recording it, and the FCA is getting a little grumpy about it, I sense. So again, if I come to you and you say, "Oh, I've got no vulnerable customers," or I've got 2% of my clients, like, it's just wrong, and there's something not quite right there. So I think risk is starting to evolve, and I think actually the DB risk sort of is starting to tail off, just because of where yields have gone. A lot of DB advice is in the money now, for want of a better expression, and so it is going to move on to the ongoing advice and vulnerability, in my view.
Can I chap in and ask a question there? Because we were trying to get down to the nitty gritty of things here, and we've heard a couple of times 6 or 7 years of annual reviews. Yeah. So what happens if you've got 2 years of annual reviews? Do you sell? Do you wait? What's going to give you the best outcome as a business owner?
My view here is that the reality is you probably delivered the annual reviews, but you haven't documented it. So there is a tedious process, and this is especially prevalent if it's going to be a share sale. It is going through and making sure you can go back and document when and the outcome from all of the reviews that you have delivered. I mean, it's a hideous process, by the way, to go through all of the clients and to pick through your emails and do it. But my genuine belief is most people have done it. It's just failed to record it. However, a buyer needs to see it recorded.
It's a good question, though, to ask yourself, I think, as a business owner. If I don't know how many of you saw the letter that was sent to the Big 22 and the information that the FCA was asking them to provide, and just how short the time frame was that they were asking for that information in as well, So they wanted to know, for every single client, for each of the last 7 years, who's had a review, who's not, what redress have you paid? And then they went one step further and they wanted to know what was included. Okay, so essentially, thank you for that summary. Now give us the proof. So a question to ask yourself is, if you received a letter today, or if an acquirer said to you today, show me your last 7-year review history, how long would that take you? Would you literally have to down tools, turn the open to closed, and spend a month trying to pull all this information together? Or would you be able to access it relatively quickly? And if it would cause any delays or any issues to your sort of general course of working, or you wouldn't be able to do that, that's a piece of work that needs to be done, whether or not you are selling. Because maybe those letters aren't going to stop with the Big 22. The FCA have got the data now. They expect you to have the data now. You're running regulated businesses, right? So it's time to see the business as much more than the clients. The clients are vital, don't get me wrong. That delivery of service is absolutely everything. But a financial planning firm is its own living, breathing entity as well. And what we find quite often when people come to sell is they have great client outcomes. They've not invested appropriately into the actual business.
Thank you all. Final question in this area. So again, came in from a few people. The FCA's obviously spending a lot more time focusing in on this area. Gabby, what's your view on what that scrutiny will mean in terms of what acceptable risk looks like for buyers in, let's say, a year or two's time? Because that obviously has a bearing on how sellers need to best prepare.
Just to be clear, so what the FCA are doing now, what impact will it have on what we're doing?
Yeah, so how do you think the FCA's view of this area, so M&A generally, is going to evolve, and what bearing do you think that will have in terms of kind of your view as a buyer on acceptable risk and therefore how sellers should be preparing?
I think it will continue to evolve. The Consolidator review letters have not gone to everybody. I think they will. As I kind of alluded to earlier, I think they're asking the right questions, and I think their focus is, as it should be, on the client, and the questions they're asking are far more informed than they ever were before. So everyone is more informed about this space, and they're seeing that perhaps the private equity backers, it's more expensive, debt is more expensive. It may not be as easier to finance these transactions that they thought it would be kind of in 2020. So I think their focus, like I said earlier, is on the longevity of the buying firm. Is it sustainable in the long term? And I think those questions will continue, and I think they're a force for good. For buyers, those questions, I mean, we actually had a call on this with our head of compliance yesterday, and we're not troubled by them. We haven't had the letter yet. I think we'll get it, but none of the questions trouble us particularly. And we need to make sure that we stay in that place, and no acquisitions that we do compromise where we are in that. So clearly we look at acquisitions or potential acquisitions through the lens of what exists and what's coming, but always through the lens of what's best for the client. And the clients, the FCA wants to know that those clients are going to be in a home that's sustainable, has longevity, and is able to look after them if there's a complaint ultimately, because they don't want it to end up with FOS. So just awareness, staying on the front foot with everything the regulator is doing. And fortunately, we have a brilliant chief risk officer who loves staying abreast of that. But I think it's hugely important.
I think it likely means as buyers, what's acceptable to us is hardening and becoming more red line, because we know as we acquire more businesses, our profile goes up, the likelihood of an FCA letter coming to us increases. If we then write back and say, well, actually, we can't provide all of this stuff because we acquired all these businesses that never had the data, that does not put us in a good light. Certainly sitting here as a director of the firm, I don't want to be sitting in front of the FCA saying, I didn't know what I was buying. I just chose I chose to ignore the due diligence, the fact that they'd never recorded anything. I had no idea what DB advice they'd got, so I haven't put aside any capital for potential redress. These are things that are very real considerations, sitting here as a director, and I take that really seriously, that I have to be knowing what I'm buying. And so if I don't know what I'm buying, I'm probably not going to buy it. Or at the very least, it is going to impact on your price.
We have a saying, which is where FCA focus grows, due diligence follows. So if you are thinking of exiting at some point in the future, be super aware of the FCA's focus and don't necessarily see it as, well, do you know what, that's just something that applies to those large firms, and they're so far away from me, it's not going to impact on me. Really keep a keen eye on what that looks like, because I think the expectation is something like 2,500 business owners are going to be looking to exit in the next 5 years. Okay. And we're seeing a slowing down, in particular with some of the larger consolidators, because, for the reasons we've discussed, more FCA focus, more due diligence to do, the importance of integration. Some of these acquirers have had to stop whilst they just look to integrate, what they've previously bought. So if you're coming up to sell in the future, you need to work out how you're going to stand out. So if there's 5 profiles on a buyer's desk, why are they going to pick your profile, right? And that is so risk driven. And if you can go to market in a few years, essentially with like a full service history, to say to a buyer, look, to me, compliance hasn't just been a tick box. I've really invested in compliance and governance. Here are my last few annual reviews of the firm. Here's how my T&C's been running. Here are my file checks that I've been doing, right? Instantly you are going to stand out compared to a lot of others that are coming to market. But what that means is you've got to invest now. You've got to spend the money now. And you've got to invite, check and challenge now. And that can be really hard. What we tend to find with sellers is the sellers of larger firms, they actually tend to, not exclusively, but they tend to deal with the process a little bit better because they have leadership teams internally. So they're used to check and challenge. And usually the owners of the larger firms, they know where they're good, but they also know where they're not so good, right? And they're open-minded to that criticism. It can be really hard for somebody that, essentially has been the master of their own destiny to all of a sudden open themselves up to a ton of criticism. So, again, it brings me back to the point that I keep making, which is view your business through the lens of a buyer, understand what challenges you're going to receive, and welcome that, because it is much better for you to find the problems in your business than for a buyer to find the problems in your business later on.
Thanks,
and there are some really easy things you can do for that. You know, out there, you've got a whole host of compliance consultancies, whether it's the Verve 360, God knows what. If you've got some DB in there, get it reviewed. Get it reviewed, because the other side's going to review it anyway, and you can go, clean bill of health, nothing to worry about.
Yeah.
And listen, we'll look at that and go, who did it? We'll move on. Thank you very much. You know,
Might as well get there first.
and it's exactly that. Be in control.
100%. I'm keen to leave enough time for our last two sections, which are on valuations and post-deal integration, which are super important. Just before we get to that, any burning questions on either preparing for sale or packaging risk effectively? Right, all good.
Can I ask one more question about annual reviews? I like your answer, Dom. The answer, I think, to my previous question was, get your house in order. I have a follow-up question. What about if not all of the reviews have been done? What should people do then?
Redress.
Take a look. You know, not necessarily, you know, right, how much have you had and pay it back. But you've got to have an explanation, right? The kind of consolidated output from the FCA's findings was that 2% of clients had essentially slipped through the net and not received an annual review, right? That doesn't sound too horrendous. And then there's this 15% of like grey, which was, you know, these clients haven't responded to our requests to review them, right? Et cetera, et cetera. That's the focus area. So when it comes to building out your 7-year review history, it's going to be quite obvious the clients that have just slipped through the net or haven't had the review, right? Pay them back, deal with that, get that matter sorted. But in terms of the ones that you're struggling to connect with or, you know, just aren't responding, it has to come the point where you question, do they really value what we are providing?
You need a process to disengage them. So you need a
Gotta have a
written process to disengage.
Absolutely. Let's move on to valuations then. So we've got a couple of questions around this. I'm going to start with one from Taras Ryback. Is he here? There.
Hi, thank you. So my question, not exactly about valuation, but more about risks which are linked to valuations. So given current economic uncertainty, are you structuring deals taking into consideration potential market downturn? And I'm not talking about correction, but more like 2008 scenario where everything goes 40-50% and stays there for some time.
Dan, do you want to
and what do you think will happen with the heavily leveraged debt-funded deals that we see? Obviously, I know the answer, but how do you think 2008 scenario and impact in valuation and in business in general?
I think, you know, if we're in that scenario, there's only so much you can do. You know, most buyers will only pay 50% on day one, so you're sort of somewhat protected from that perspective, and then there'll be recurring income targets. But ultimately, you cannot mitigate or hedge a lot of that risk. You know, you've just got to accept it ultimately. I mean, in terms of debt, yes, if you've got acquirers that are more heavily leveraged at this point, then, you know, maybe spend a little bit more time thinking about whether that's quite right. I've never been entirely convinced about adding financial leverage into operationally geared businesses, but that's just a personal opinion. But look, there's not a huge amount you can do if the market crashes 50%, to be quite frank.
So I'll have a go. So it comes down to how you're going to structure your deal, and you get to input on that. Yes, we'll come up with heads for you, but in that conversation, talk about what it is you want to achieve. So when we structure deals, for example, yes, we're looking at what your recurring revenue has been historically, and we're going to convert that into an adjusted EBITDA in our own business to determine how I'm going to price my offer to you. But often the deals are done in saying, well, have you hit the number that, you know, whether your recurring revenue was £1 million, for example, have you hit that? But you could structure a deal that also allows you to include future new business that you're writing to offset against that, for example. So if you've got downturns and you are a strong organic growth business, you are naturally protecting yourself against that if you put that in as a mitigator. Now, you can have that as a mitigator, or you can have it as a ratchet in terms of your own valuation. So some people say to me, yeah, Phil, but I'm on the upturn, here. Why sell now when I could sell again in 3 years' time for a lot more money when I've got a lot more recurring revenue? And I'll say, well, okay, what's the proposition you want to work in? What else can you provide to your clients? And what if you could benefit from the upside during the term of that this deal? So all of that is in the art of the possible. If you're really worried about that downside and sharing that risk with the buyer, great. Just structure your deal differently.
There are levers that can be pulled, for sure, in that. Blending out of the deal term, potentially, elongating the deal term. Usually people want a short deal because it's, cash in the hand and all that, but actually a longer term deal can help where markets are turbulent, and if you've included some form of blending. Like you said, what can we do around future assets that are going to come on board? What if the clients are retained across the deal term, but through no fault of anybody's, market returns have meant that there's going to be a reduction? Well, can you then agree in the purchase agreement in advance that actually you have the ability to carry some value over into another year? And buyers, they don't want to take it. Well, some of them do, but the majority of good buyers, they don't want to take advantage of a business owner and try to crucify them because of a moment in time, in particular when they're looking to keep these businesses, for 5, 10, 15 years themselves. And they are usually accommodating around protection, because the reality is buyers know we're buying a firm in its entirety or a book in its entirety, but we're only paying 50% or 60% up front. So they have to allow the sellers the ability to earn those deferred payments. And something we've not touched upon yet today, but is absolutely vital, is good legal support. I cannot stress enough how important it is to have amazing legal representation on your side, somebody that really understands the buy and sell of financial planning firms, because it's very simplest. If you break it down really simply to what your lawyer's role is, it's to try to protect the money you've left on the table and try to prevent buyers from being able to bring claims against you that will reduce those future payments, right? That's their role. And both sides can usually find a common ground around how do we structure, or how do we put clauses in the agreement that ultimately can benefit both parties.
Dom, you've done a lot of recent deals. Are you or the sellers factoring in a potential downturn for deal structure?
So there's multiple different ways that we can do it, and have done it different ways in the past. One of the ways you can do it is we've looked at sort of based on pre-completion recurring revenue and actually the buyer accepting all market risk, right? But then that's going to go to the multiple that you're paying. So if you're going to take all market risk as the buyer, you're probably going to pay a slightly less on the multiple. But I tend to view it as we're long-term holders of a business, right? You're buying a business for the long term. Our payback period, we recoup our original investment for 5 years. I'm buying these before you then start moving into positive return territory on an individual acquisition. So it's all around making sure you've got that longer term view rather than a short term market cycle. So yeah, we would structure deals differently, whether you put a cap and collar on an earnout. So we've got an earnout that is revenue contingent. You'd say, okay, well, 20% upside in the market you get the benefit from, or 20% downside, right? So that you're sharing the risk, but then actually you're capping the upside and capping the downside risk in what's called a cap and collar in the legal structure. There's many different routes that you can take to protect from market volatility, or, as I think Phil was suggesting, including new business, for example, to offset market falls. So lots of different mechanisms. Just briefly picking up on your second part of your question, if I may, on the overly leveraged consolidator or buyers. I mean, the answer is they're stuffed, right? So in an example, in a 2008 scenario where they were struggling when Liz Truss and her mini budget and interest rates went up a bit, if you're in a 2008 situation, they're stuffed.
Gabby,
So
do
it's
you
not
want
a
to add
great-
something? I'm conscious you might have a mic problem. But
Just to summarize all of that, I mean, it's about understanding what you perceive to be the risk and getting and structuring that through the deal, which is infinitely possible through the many ways in which we've described. But back to the lawyer, Vicky makes a really good point. Get really good legal representation. Get someone that's operated in this space before, because you can have a brilliant local lawyer or a brilliant lawyer that's done many different things for people you know. They need to understand the nuances of this space. So
it's not just the nuances as well. I think when you're trying to sell a business and we're trying to buy a business, you want a win-win, right? The goal is not to have a lawyer who's scoring points against the other lawyer to show you how good they are. And many a deal has been lost because of a crap lawyer. Just literally trying to prove a point and arguing over something that actually isn't important to you as a seller, and stick in the mud. So it's also the case that someone does have to be experienced really in selling financial services business, so they understand recurring revenue. They understand how these things work, because if they don't, it's a problem. They don't really get how the deal is put together, and they will get in the way of it. And typically they'll take so long that the buyer will get cold.
Could I just say quickly as well, a big mistake I think a lot of buyers have made that becomes very evident when markets are suffering is they haven't bought ambitious businesses. Buyers have rubbed their hands together with glee at acquiring firms that are 90% recurring revenue, 95% recurring revenue, because look at all that secure, juicy income that's going to come in, right? Lo and behold, markets falter, and I've got buyers saying to me, Vicky, nobody's writing any new business. That we bought businesses that weren't writing new business, okay? You bought businesses that looked like they were growing purely because the markets were doing well. There are some amazing, ambitious firms out there that are bringing in a ton of new business at the same time as servicing clients. And regardless of market conditions, those books tend to be growing because they're constantly putting more and more fuel in. And yet I still struggle with buyers where sometimes they want to, down value certain ambitious businesses. I think, oh my goodness, learn from this, new business is the lifeblood of a firm. It's not just about recurring revenue.
My clarity to that will be the addition of the word net. So we look at in our data net new business, because you might be putting on 10%, but if your age profile of your client bank is so old that 15% is going out the door, that's not a growing business. So when you're preparing your data, think about what your net new business is for that organic percentage.
Great points. We're going to take one final question in this section from Stuart Hood. Where's Stuart?
Thank you. You've touched on this quite a bit anyway, but with regards to the valuation multiple, whether it be EBITDA or revenue or whatever figure that comes out to, what would you say were some of the key non-financial elements that affect that multiple that wouldn't necessarily kill the deal, but could make the difference between, say, 4 times EBITDA and 3?
Who would like to take that, Dan? Or yeah.
Yeah, I can take that. I mean, typically for us, we're looking at age of clients is a big one, and also size of clients and the revenue associated from those clients. We don't want to be taking on a business with 500 households, all of whom have got £100,000. It's not economic, and it comes back to what Phil was saying about your target market, and that's not our target market. So really, it's age and size, and then for us, it's geography as well. We deliver pretty much all of our service face to face, and so I don't want advisors driving to the north of Scotland or south in Cornwall that often. So it's got to be Midlands based for us.
Any other big ones you'd call out, Phil, that we haven't covered?
There's the obvious synergy there. If you've got the same back office system as me, the same cash flow tool as me, the disturbance for the client is going to be so much less, and therefore it's much more attractive.
How do sellers get to know that though? So in thinking about all the buyers that they might want to work with, how do they get information on things like which back office systems you use and that sort of thing, so that they can align?
A good advisor will know.
Representation. Somebody that understands the market, knows who's out there.
Vicky would know of the buyers she works with, what they've got, so you can get quick answers to the simple questions straight away. But a really important thing for us is professionalism. whether you're chartered or not, that will be helpful. The kind of ambition and career trajectory of the people in the business, because they're the future. Who are we bringing through? What talent are we getting our hands on? Getting to know the people in the business and what they can bring to the group and how we can help them move through the business.
I would say as well, sometimes acquisitions are strategic. Like sometimes people are coming on, or businesses are coming on board, and they maybe open that acquirer up to a new service range or a certain niche, like a divorce specialism or step or solar, or whatever that might be. And actually, a buyer could take a look at that and say, do you know what? We're not just going to benefit from the profitability that this firm is generating through that piece, that work that they do. We can also use that across the other acquisitions that we've got and make better use of that. So if you become strategic to an acquirer, then that's where you start to sort of move slightly away from the multiples that the market are quoting, and you can look to achieve something that's a little bit better.
We're going to talk about integration in just a sec. Just before we do, I'm going to do a quick fire down the panel. Valuations 12 months from now, higher or lower? You're allowed one word, that's it. Phil?
Lower.
Higher.
Same. You didn't say what word.
Lower.
Okay.
Lower.
Bit of a mix. Okay. Right, so let's talk about integration. John Barham has a question on this. Where's John?
Just before I hand over to John, can I ask another question? I know I'm fielding questions rather than asking questions, but I've been asked this quite a few times. We talked about target client market and making sure you pick a buyer who has a similar target client market. I think that the majority of firms, their clients will not all be within their target market. So they will have some that are maybe higher value, some that are lower value. How does that affect a valuation? Is it better to disengage with clients before starting a valuation process? Is it better just to go through? Is it better to do a split acquisition? What's your view?
So actually, this is what Vicky and I were talking about earlier on, which we never actually got to when we started this conversation. We apply different recurring revenue multiples to different client segments. Right? So, I mean, our target market is a high level of ongoing service, face-to-face clients with more than 250,000 on a household basis. And our average is around 500,000. But there is a segment of clients sort of below 100K that are not connected to other clients, and maybe not sort of young entrepreneurs who are going to be the sort of future face-to-face clients for us. There's a segment of clients below 100K where actually, a bit like Phil was saying, but at a lower threshold than Phil, we can't deliver the service profitably to those clients. So what we are looking at doing is, yes, we'd apply a lower multiple to those, but actually establishing a relationship with another firm that specializes in that, where actually certain clients could be ring-fenced and go off to a firm that can specialize in telephone-based advice for clients in that arena. And this is independent telephone advice, not a two-lettered firm that would charge them quite a lot, based up north. Sorry. I think we're not meant to be controversial. And then we're also looking at a hybrid advice proposition for clients between 100 and 250K. We're not there yet. We're still doing it face-to-face. So a slightly long-winded answer to your question. But yeah, we do apply different valuation metrics to clients depending on the extent to which they meet our service proposition. But then we've also arranged for a solution for the clients that don't meet our target market.
Thanks, Tom. John's question.
I think you've touched on an aspect of this in relation to minimising disturbance to underpin the ultimate valuation of that business. Your point, Vicky, about you don't know how successful you are until you get your final paycheck. So in the context of each of your experiences, what does the integration journey look like for clients? And I guess specifically in reference to the kind of fee and the investment solution, that would be great to get some feedback on that.
Gabby, do you want to go first for that one?
Yeah, no problem. I mean, there's the stuff that impacts the clients, and then there's the stuff that impacts the business. And a lot of the stuff that goes on in the business, the clients don't see. So the back office stuff. For the clients, it shouldn't be dramatic. It should be really smooth. So clearly, when you acquire a business, you have to write to those clients to let them know there's been a change in ownership. You have to do that. And the overriding message in that letter, and there's actually two letters, one from us as 149, one from the firm that's been acquired, is your planner is staying the same. Your support network's staying the same. And ultimately, if there's consistency in the person that's looking after that client, they're not really that interested. So that's the first knowledge they have of there being a change in ownership. And then when the advisors go and see that client, it's only at that point that is something discussed with them. So our headline fee rate is 1%, but that's looked at in the round. It could be that they stay at a lower fee rate if that's appropriate. We look at it from the perspective of what value are we delivering to that client, and if it's not appropriate to charge them 1%, we won't. It's a conversation to be had with that client about what we're delivering. So nothing is changed broad brush. It's done in concert with that client at the annual review or at a meeting with them. So nothing is changed just by writing to them. You have to have a conversation with them. And the same is true of the investment proposition. So we have a discretionary investment management business that actually predates any of the advisory businesses that we bought, that has a track record spanning over 5 years, is performing really well, is quite very competitively priced, and it's got really low volatility. All we'll do is say to the planners is, could you see if this might be better for the client? You as vendors are not remunerated for shifting clients to our investment proposition. And I can't say that with enough emphasis. There's a clear conflict if you as a vendor are being paid by virtue of your clients moving to our in-house investment proposition. So it's got to be right. It's got to be demonstrably right for them. So they may see a change in their investment proposition if it's less volatile, better performing, cheaper, demonstrably better. They may see a change in their fees if we're delivering the value to substantiate that. Beyond that, it's the same planner going to see them, the same support network. So they're not overly concerned. I mean, the last thing we do is rebrand a business. We're not precious about our brand. I think that's kind of a vanity point at the end. The first thing that we do, and for me, when you come back to being a director of the business, for me, it's about safety, governance, oversight. The first thing we do is look to get you onto our version of Intelligent Office so we can see what's going on. We have absolute clarity over where that client is in the advice process, where they are at the annual review, and we also have clarity of the numbers. And the same is true from a compliance perspective. So again, one of the first things we do is get you on our compliance regime. I couldn't sleep at night if our chief risk officer, who I've described as the geekiest SWAT in the world as it relates to regulation, wasn't comfortable with what was going on from a regulatory perspective. So very long answer to a short question. It should feel very minimal for the client, but you and your team should know exactly from even the first conversation with us, even prior to that, if you have our kind of acquisition pitch deck, exactly what integration looks like. So it's about transparency and getting on board with exactly what the changes are you're going through as a business, but minimal disruption to the client.
Dom, keen to get your take, but can I tack on an extra question that we've had in, if you're happy to take it, which is, what's been your worst integration and what did you learn from it?
I think not integrating actually has been some of the worst integrations. So it sounds a bit odd, but it's when you're failing to manage expectations around actually integrating a business. But if I can come back to if I explain how we approach it, and there's slightly different approaches depending on whether we have financial planners joining us or teams joining us, or whether it's a retiring principal, which most of our transactions are. And in either situation, in terms of aligning clients to our fee model, all clients join us at their existing level of fee, right? So they all sign our terms of business at their existing level of fee. But then we need the path to align them to our 1% advisor charge model, which tiers down for some higher threshold clients. And that path is, if we are able to, in the first year, align them to our 1% advisor charge through lowering their overall costs, so changing their investment solution, for example, then that is what we will do. Obviously, the investment solution has got to be better for the client. And we actually say to our financial planners, or I say to them, I don't want you to recommend our internal DFM unless you believe it's the right thing to do. So it's sort of a similar mindset and ethos to Gabby in that respect. But if we can't lower the cost of the client overall in year one, we'll then signpost that, look, at your next review meeting, we will be looking to increase your fee. But let's prove our service to you over the course of next year. So we give ourselves a 2-year window post-completion in order to align clients into our ongoing advisor charge. Now, there are always some concessions in a process because of specific circumstances, but crudely, it's over a 2-year period, but having evidenced our service delivery to the clients first.
I'm going to ask one more quick-fire question to conclude the question time segment of this session. You're only allowed one word, I'm afraid, again, and it can only be stay or go. What do you think works best in terms of whether the seller stays or goes? Stay or go. Okay. So wait. So Dom says goes. Okay, Gabby.
Go.
Stay.
Vicky.
Oh, can I please have more than one word? This is really important. Right. I'm sorry. I know you would want
It depends on the vendor.
It is. It does
It does depend, right? I think if you are exiting, if you're selling to retire, okay, then go. You know, you don't need to take your advisory permissions over there. You don't need to learn a whole new compliance regime of how to work and how to operate in that world. You can still do the amazing bit with clients and be that ambassador and enjoy going out and seeing the clients and handing that work to somebody else. So in those scenarios, I think, you know, sellers should look to go. It becomes incredibly challenging for them when they are of a certain vintage. So we're saying they've worked in a certain way for a very long time to expect to be able to adapt to that sort of environment. But then, of course, we have the other sales, which are the younger, more ambitious teams, and they're the ones that actually you're pinning your hopes on as an acquirer for future growth, and you obviously need them to stay. But yeah, retire if you're retiring, you know, get out as quickly as you can, in my view.
So if I had a couple more words alongside the stay,
Nice.
I would have said for at least 2 years to do a handover of your clients.
Yeah. No, it's a good point, and it was an unfair question. I mean, certainly it depends. I'm part of a PLC that's acquired quite a few businesses recently, and the reality is that the right thing for some of the founders or leaders of those business would absolutely be to go for both parties, right? And for others, absolutely to stay. That concludes the question time element of this morning. We're just going to spend a last 5 minutes sharing some of the ways in which firms are using client feedback to help ensure that clients are kept front and center of things throughout the M&A process. We've just got a couple of data points that may interest you. One thing that's really struck us in our conversations with our members on both sides, so sellers and buyers, is that there are sometimes quite big gaps in terms of the MI available through the deal process. So we've started experimenting with various things, and we produced a draft client insight report. Happy to share the full version with anyone who's interested in seeing it. The aim of it really is to help good sellers command the best possible valuation on the strength of their client feedback, and to help buyers understand what they're really buying. There's quite a few different elements to it, but to sort of bring one bit out. So in simple terms, on the left-hand side, it shows you a variety of different value markers. So ranging from percentage of clients giving a 5 out of 5 rating on value for money, through to percentage of clients who say they're confident they're on track to achieve their goals, through to, very topical, given the ongoing services review, percentage of clients who speak to their advisor at least once per year. What you can see in the blue circle is the seller's scores. You can't see the key at the bottom, but you can see in the blue circles the seller scores, and then you can see in the green circle how the buyer compares, and you can see all of that plotted against industry averages. A lot to take in, but like I say, if you're interested in seeing these averages afterwards, happy to supply them. There's been a bit of talk around organic growth earlier. We're certainly, I mean, there's obviously only so many firms that can be bought up, and you want to do a good job of making sure that the sum is greater than the sum of the parts. So we're seeing a lot of buyers focus a lot more on organic growth, and that includes pre-deal. There's a variety of metrics that you can look at from client feedback to understand organic growth potential and the ambition of that firm, to use, I think it was Vicky's words. One simple metric to look at is how many times on average the firm's clients recommend their advisor. So in the case of one particular seller that we're working with, in the green charts, 1.4 recommendations per client per year, which is slightly better than the industry average of 1.2. We've talked a lot as well about the integration process and making sure that clients stick around. A lot of the buyers that we work with will work to a rough expectation that around 4%, kind of worst case of clients, may decide to leave post-deal. Obviously, the lower that figure can be, the better. And we found that a good way to ensure that that number is kept to a minimum is listening to them. So just really making sure that you're collecting feedback from those newly acquired clients really, really early on in the process. As a minimum, they feel listened to. Ideally, you're then acting on their feedback. and making sure you're implementing any feasible changes. This is feedback left for, what it shows you is a star rating left by newly acquired clients of a firm that we're working with. The right-hand chart is the percentage of clients that gave a 5-star initial first impression rating of the new advisor that they're now working with. Left-hand side shows you the percentage that gave a 4-star rating. So the majority are giving good ratings, but it's really helpful to understand that and look at ways that you can improve it. And this is a nice qualitative bit of feedback left by a newly acquired client for their advisor recently. From the first meeting, David struck me as trustworthy and committed to putting my interests first. We've spoken a lot about the need for due diligence. The FCA is focusing a lot more attention in this space. A challenge for a lot of buyers can be that they've brought together a lot of firms who have perhaps measured things in different ways, or sometimes not at all, which presents buyers with a challenge sometimes because they've got a bit of a patchwork quilt of data to take to the regulator, which can be difficult. Where client feedback can help, provided it's collected consistently across the buyer and all its component parts, is it's a consistent data source. And it is, I guess, in some senses, the ultimate source of truth because it comes directly from the client. Various data points that you can collect, for instance, how many times the client says that they're interacting with their advisor. This one's looking at how confident the clients feel they're on track to achieve their goals. In this case, the firm, who's a big acquirer on the top, is doing pretty good. So only a small percentage of their clients are saying they're not sure whether they're on track to achieve their goals or are only quite confident. And that compares well with the industry average. Talked about organic growth. Again, client feedback can help with this. Interesting learn for us in collecting feedback from clients over the years, and we've now collected feedback from several 100,000, is that most clients say they'd recommend their advisor, which is really, really positive. However, when you drill into the data, the majority of those clients will only recommend in certain circumstances, or if one of their friends says that they've got a particular need. There's around a quarter of clients, we call them passionate advocates, who are truly delighted with the service that they are receiving. And they make 2.5 times as many recommendations as everyone else. Client feedback can help you identify which category your clients fall into and can also show you how to move them from one to the other. And the last point, which has been touched on as well today, is we're seeing a lot more sellers doing due diligence of acquirers pre-deal, right? It's not just about the number, it's about making sure that their clients are really looked after post-deal. MKC Wealth and 149, I know, do a good job of publishing their feedback, and that just helps with that research. Anything that you can do as a buyer to help sellers buy into you, understand that you're the right home for their clients is super powerful and increasingly worth doing.
Did you say you were 4.8 out of 5, Gary?
We see it going up year on year and year.
And I must say, credit to Dom, he did mention this earlier, but absolutely everybody in his firm, their bonus is linked to their client advocacy score based on their client feedback, which is not only a great thing to ensure that you drive the right culture, but it's a powerful thing to be able to share with sellers, of course. We're going to end it there. I'd like to say a huge thank you to our panel for sharing their time and insights. Thank you. And a massive thank you to all of you for coming, for navigating the London Underground and the various roadworks going on in the immediate vicinity. We really, really appreciate you joining us. Hope that we've delivered on our promise of leaving you with some food for thought at the very least. If ourselves or Melo can help with anything moving forward, please feel free to reach out with any questions. Thank you all very much. Have a good day.